Boa tarde a todos, sejam muito bem-vindos. Muito obrigado pelo interesse no nosso call de resultados referente ao quarto trimestre de 2022. Bom, eu vou começar, antes de passar, a gente normalmente iria direto para o Q&A, eu só vou começar falando um pouco aqui do que a gente divulgou ontem sobre a mudança do nosso modelo de parceria com o Ellison, que está aqui com a gente desde do início da nossa operação. Então, o Ellison iniciou conosco em 2019, focado principalmente na evolução da nossa tecnologia, que era a nossa prioridade naquele momento. Ficou praticamente um ano e meio fazendo isso para essa evolução acontecer. Em novembro ali de 2020, nós adquirimos a i9XP, uma empresa de tecnologia focada em atender grandes e-commerce. Nesse momento, o Ellison fez a passagem da área para o Edson Tavares, que era o founder e o atual CEO da i9XP naquele momento, que assumiu aqui na Via a posição de CIO e vem fazendo uma consistente evolução da nossa plataforma. No início de 2021, o Ellison passou a colaborar com a evolução do marketplace, enquanto o Edson focava na evolução de todo o nosso parque de tecnologia e na tecnologia no marketplace, principalmente no onboarded seller. Vale lembrar que nós iniciamos 21 com 4 mil sellers e terminamos o ano com mais de 120 mil sellers somente em 21. Então, enquanto isso acontecia, o Ellison colaborava ativamente com o grupo que estava fazendo o desenho estratégico da cauda longa e do papel do marketplace na Via. O plano estratégico do marketplace se consolida no segundo tri de 22, quando a gente declara que a gente estava direcionando todos os nossos esforços para a cauda longa,
directing all of our efforts to the long tail with a focus on increasing recurrent and customer volume. So in mid 2022, Edson left the marketplace and he started taking on our position as people and performance. So I just wanted to say that Alison brilliantly fulfilled his mission here at Via, starting the digital transformation, supporting us with the evolution of our marketplace, and really helping us in the innovation. Alison, we want to say thank you so much for this great partnership that is definitely not stopping here. What's happening now is that we're maturing a cycle. This decision is in a very way and in common agreement. And to support Via as an advisor in all of the innovation process. So having said that, we'll also be working on some changes here in reorganizing the C-level. So Sergio, he was our C-level and he was conducting investor relations, communication, and logistics. Now accumulate on performance, and he'll stop focusing on logistics. And he is our CTO. Sorry, he will accumulate the logistics department as well. So as part of his job description. So with this major change that we believe is key to have a bigger advance in the intensive use of technology and data analytics, we believe that we're taking on a whole nother leap our performance at VIA, which interacts a lot with all of the evolution of our logistics and accuracy of our deliverables to consumers, and all this brings in a direct relationship with strong evolution that we have with our volume of. So, please find saying what's going on at this moment and that we are absolutely planning this. This was a scheduled and a planned move and agreement and collective member with us as advisors supporting us in the entire innovation process. Gabriel, the floor is yours, and now we can great. So thank you, everyone. Our first question is from Size from Citibank. João, you may proceed. Thank you, Gabriel. Good afternoon. Uh, well, about your operating plan, you talked about this a bit. I think in last revision of when we were thinking about this, and I wanted to hear your strategy now change expectations of environment. And also, if you could talk about the marketplace, you've been talking about this issue with Edison, but now as a bit of the in the detail, and I wanted to hear about the average ticket since you're advanced along. It seems that this average ticket brings in a bit of pressure, so we wanted to know about this and how we're looking at 3P going back to expanding and having robust growth. And if possible, there was a bit of here a bit of growth of expenses. We had significant growth in expenses in the fourth quarter. And how do you consider the situation for 2023? Perfect, Jerome. Thank you so much for that question. We're going to start with stores. So we opened 60 stores last year, and we closed down 21 stores. From these two, anyone we closed, basically that's for performance. So something we've been working on this full, and here we would be able to fit in about 60 and 80 stores. We've already mapped this out, and it would be about 6 to 80. But with the entire context going on and the interest rate happening and all these questions, we really changed the plans, and we've we should have about 5 stores this year. That's a roadmap we were already setting for a while. POSs we had already negotiated, but we, basically here the scenario, once it's improving a bit, we can accelerate this very quickly. So stores seem to be very resilient. This entire period, we grew 16% in the fourth quarter in physical stores. If we look at the store network, we have so we've been keeping up with this same pattern, and we believe we need to work on this a little better as things get. We work on this evolution. This involves this. It's one of our relationship with consumer increases our penetration, and there's this full structure behind the stores. So for this year, about 5 to 10 new stores. When you look at AP and our strategy, yes, we follow along the strategy to continue to evolve with average tickets that are a little smaller. We've moved on not be below 100 reais, so that's not our target here. 200 maybe no doubt um, we will continue to value long tail because we've seen very clear signs. We can see the level of recurrence with consumers. It's been growing in frequency as well, the amount of items per purchase as well, and this has been growing. We grown 79% in the volume of orders in the fourth quarter in the long tail, and we were able to balance out the GMV. So when we set up this strategy, this really strengthened the marketplace with core items. And from then on, we had a drop in GMV. We've already balanced this out. Growth of about 20%. This growth has we've continued to see at levels that are higher or the same in January, March, and we continue to be extremely focused on the strategy to gain. So now the third point on sense. I'll pass this on to Padilla. He can provide some details on this fourth quarter. But I think it really makes sense to look at the expenses year over year because effect stops existing, and then we'll have a level of expenses that we consider more. a very strong plan that we've been moving along with, and a very aggressive plan for performance gains and greater productivity, which is really the fruit of all of the investments we've been doing in the last few years and a reduction in expenses. So I think here we do have room to think of something that's about 2 points of EBITDA coming from all of the gains we've had been demonstrating this year. So Pajide can get into the details of the fourth quarter. So um, as we mentioned, there's a bit of a distortion uh, in regards to some credits that we had seen in that quarter that would be distributed during a year, but they were concentrated in that specific quarter, so it gets a little distorted. But the best indicator really is the level of expenses in the year. We're talking about 24.2. That's pretty much the level that's recurrent. Without the labor effects, about 23.30. That's the recurring level. And it's really difficult to compare the total expenses with the market because we have operations with the uh, DC in the entire operation, which brings in some possible difficulties as well for comparison. With the if we exclude the NPL effect, so we're talking about a level of expense that is probably the more comparable number when looking at the rest of the retailers in Brazil. And so we have been in this level um, for the past 5 quarters. So we've been working on this, and this has been very important for gains in productivity. And Roberto talked about 2 points, which is really our target here. We've been focusing strongly on this continuity of our expense reduction plan for 2023. So we have a very strong target as well to search for these 2 percentage points and increase the profitability of the company. Very clear. Padilla and Roberto, thank you very much. Thank you, João, for your participation. Our next question is from Pedro from Bradesco. Please, Pedro. I think you're on mute, Pedro. Can you hear me now? Okay, great. Thank you, guys. All right. Good afternoon, everyone, and thank you, Gabriel, for taking my question. I'll work on two here to make things a little simpler. First, we would like to hear from you guys about a bit of the takeoff in the year with the sales performance, but also the gross margin, and not only from a quality perspective in the stock, which seems to be very good, but also considering default impact as well. And also taking advantage of the second question, I would like to know if we could get a bit of your mindset um, on the capital structure. We can see a big opportunity for market share gains, which would basically require some levels of investment, and how we can equate this in the best way. If we discount receivables, it's going to be something like a primary. So we just have these two main topics to discuss, and thanks, guys. Okay, thank you, Pedro, for that question. About 2023, yes, we did have a challenge right in the beginning for default. And so I think we're handling this pretty well. We've seen a bit more rationality in the overall market, and this has been quite positive for competitive advantage. And this is a scenario we like playing in where profitability can be preserved. And so when it comes to the quality of the stock, we have pretty good quality. So we had a significant reduction in the volume of stock. We started off in the previous year where we really focused on the pandemic due to a lack of products. And then as this was structured, we reduced this without margin pressure. So considering the quality of the stock, we were able to remove all of the stock without pressuring our margins. So that's where we really have the quality of the stock and a very low rupture rate. So we see there's a balance in the margins in the first quarter, and we've been able to reach levels of market share gains that I'd say now in March, we've had some signs where our market share is really at its maximum historic level that we've ever had when it comes to online. And so that does not mean the growth of 1P. 1P is still a little complex. In our 3P, we've had strong growth as well, and in the stores, we continue to be quite strong as well. So we're very focused on purchasing in this store, in the physical store. So this is a bit of the radar about the capital structure here. We were able to have a reduction in the stock. We may have some fine tuning, but we had the payment terms that have been completely equal to the level of stock. Um, but this is very important for this growth movement and trend. We've been moving along very well for the renewal and postponing of these payments. Um, and so this is very positive. Um, and we are in a scenario where we can really grow and capture the market share. So part of our sales come through the buy now, pay later system. Uh, so we've been able to grow to be able to have this level of growth that we've been estimating. And if we don't have the total, it's very close to the total. So we believe that the market should have an improvement when it comes to credit throughout the year, and also discounts on credit cards are as an option. But at this moment, we're not working on um, a bigger debt level, and we want to roll out on a bit of the debts that the company still has for this year. Oh, yeah, that's perfect. We've had very advanced conversations after all of this advance with a big event with a big retailer. The banks positively provide some signs that with the payments we have to that are going to be reaching maturity in the second and third quarters, these have been moving along very well. But I want to reinforce one point here. The company had very strong cash generation this year. So next year, we are foreseeing a lower cash exit with the possibility to also keep a level that's very high in monetization for taxes, close to about 2 billion to 2.5 billion. And this also helps with all of the other elements that Roberto has mentioned that really lever us in this achievement of the market share. So thank you, everyone. Thank you, Pedro. Our next question is from Danny at XP. So thank you for taking my question. I have two here on my side. First is a follow-up on the EBITDA margin that you mentioned. We have about 2 percentage points that we should see captured very quickly throughout the year. If you could bring in a bit of the drivers and even the path for capturing this throughout the year, that would be great, and it would help us a lot. A second point is getting back to Allison's point, and even if you could maybe give us an update on how the structure is doing and your incentive program and retention for the main executives. You had mentioned that you had some stock options that were a little older and the level of prices. So if you could give us a bit of an update if this was renewed and if you've been working on this to be able to have the retention of some of the key executives in the company. Thank you. Okay, Danny, thank you for that. About where you're going to have the EBITDA gains. I think we have this huge productivity program, and so a lot of this is based on what we've been investing in and how we've been investing on the company. So I'm going to give an example. If you see what we presented on the evolution of GMV or revenue per seller, the productivity gains we've had on based on all of them is not comparable, and it's a lot greater actually than the pre-pandemic period in 2019. So this is a small example, but it's really in all of the company's departments and areas. We had a lot of productivity coming from logistics. So we were able to add a lot of technology and a lot of algorithms that have been really uh, conducting the distribution and allocation of products. This modification now Edson taking on this position with logistics as well, and this gives us the expectation that we should accelerate the intensive use even more of technology for in logistics. So we have different initiatives in the company, and we also have productivity here at the headquarters. We've also been messing with this a bit, and we've been able to gain more productivity for a while. We had to duplicate some structures, so we had people building new things and also people handling the past things. And now we can make this become a single structure after this entire cycle. So there's a bunch of different initiatives going on at this moment at VIA. So we've been obviously we have a big challenge here, but we are very committed to this and to working on this plan. So it's nothing new. This has been something we've been working on since the second semester last year. We've been activating this plan, and now it's really we have a sequence to for 2023. So about retention for the executives, we've been also working on a recurrent stock option plan in the company, and we have another original plan as well in the company, which you were referring to back then, as the stock price is positioned at about 490 and a few cents. I'm not sure of, but this is kind of under the water. But everyone at VIA is aware what we have as value creation in VIA does not interact with the actual value the company has, and the executives are here. They're committed to the company in the long term, and we've been working on some decisions here that are quite difficult in the company that don't value executives in the short term. And but all of this is to the detriment of something we really believe in. It's 497, the value of the stock in our plan, but we had a change last year. We added up a we had the postponing of this period with the executives, and in exchange, we had 30% restricted, which is going to be maturing in the next years. And we also have a study group in our committee for people and performance in our board, and we've been studying a possible postponing of the execution of this plan from the moment when it's vested by the executive. So the barrier in the second semester of next year, and we're debating if this makes sense to postpone, and executives would maybe have more time to exercise this. It's a conversation that's doing pretty well, but we still don't have the end of the conversation addressed, and we've been working on this topic. Great, thank you very much. Thank you, Dani. So I wanted to invite Alexandre Namiaka from Morgan Stanley. Ale, please. Thank you, guys, for taking my question. I wanted to focus a bit more on logistics, especially in the fulfillment model that you consider in the fourth quarter. And we saw penetration in fulfillment reaching about 21% if you compare that with the 20% in the third quarter. and 16%, if I'm not mistaken, in the second quarter. So we are seeing a bit of this penetration also starting to reach some saturation. Could you help us understand what would be the level of penetration in this mix of services and logistics that you're seeing within the logistics for the sellers, and if there's any additional investments you have to work on when it comes to capacity, new fulfillment centers, to be able to continue to increase this penetration? Well, Alexandre, thank you for that question. I will start off here, and then Sergio can help me with the answers. First, no, we have not seen a need for investments. So Via has been reducing stocks for over a year. So we have room now to work on this operation. We already have our logistical network all set up, and we have all of the stores operating as logistical hubs. So we think that when it comes to space allocation, we really have an opportunity to bring in more players into our logistics. So I think we can split this between fulfillment and also with logistics as a service, which has been growing a lot. We mentioned a few of the players that are already doing this, and we see a demand for this kind of service. So we can be very competitive considering that the network already exists. And in fulfillment, yeah, we had growth where we were able to start off really in the second quarter of last year, and we had exponential growth. We have room to grow still a lot, and there's appetite from the seller, and so it's really about one more point of control at this moment than actually being at this limit for growth, right? Sergio, if you could add on to that. Well, that was very clear, but anyways, just about the difference in the semesters. We started off this fulfillment practice in March 2022, and we have this photograph here of the last 3 months of 2022. So we have less than 9 months evolution, leaving from zero and heading to 20%. So we consider this healthy growth, and it is impacted by a mix of categories and SKUs that can kind of interact with the system in so many different seasonalities that we went through in the end of last year with the World Cup as well. But this doesn't remove from our route a horizon of potential that we see as at least double this, so 40 or 50% penetration and fulfillment in the amount of orders and requests. You can remember that this is under that umbrella of Envias, so all of the service platforms, where we really see the potential of going from 70% and growing to a potential horizon of 70 or 80%, because there's always some people that will work on their logistics themselves. So maybe there's a balance point there. And I want to remind you all that we started off with this service, considering the cost competitiveness that we have, being able to be profitable, and we were able to charge below the average market cost. So we're really happy with the evolution we've had. And now we're going to move on to new horizons and technology intensiveness in logistics with Edson and Ajin coming in. We see this path that we've looked at with major potential. Um, we've seen the existence of NPS levels uh, for those orders that are processed through greater developments and fulfillment. So this also contributes to costs. And along with this, we've been growing a lot as well with our operation that we call the do as a service, which is really open ocean. And that also, once again, strengthens the density even more and the operational efficiency and density for new routes. So this path continues, and we will be expanding to another two DCs. And then when I'm talking about this, we are really thinking about the fulfillment and open ocean. And this continues practically without any investments due to the release of the different areas and the reduction of the stock. that I would like to highlight without affecting our stock out during last year. Okay, perfect. Thank you very much. Super clear. Um, okay, now I'm going to call Gustavo Frattini from Goldman Sachs. Gustavo, you may proceed. Okay, thank you, Gabriel. Hi, guys. How's it going on? I said we basically have two questions here. So the first one is about payment forms. And how we noticed a bit of a drop in penetration from the CDC and maybe a possible increase in co-branded. I wanted to understand what are the main reasons behind this and how much you're looking at this penetration. Um, and the second question is more about the credit panorama. How is this deterioration of the NPLs, and or if we reach the bottom, and what's the appetite for risk to provide these loans? So thank you for that question. I'm going to pass the floor on to Calabra. He can give us a lot of details on this. Hi, Gustavo. Can you hear me? Good afternoon. Thank you for that question. First, I want to talk about participation. So the fourth quarter historically has a drop in sales, which is really an effect of Black Friday. Uh, so in this fourth quarter, there was a setback a little more about the demand of credit. We also noticed consumers in the fourth quarter focused most on paying their debts, even with the help from the government support policies, the Auxílio Brasil at the time. So that's a little bit different than what we noticed historically in the fourth quarter. So this was the same as the fourth quarter of 2021. So as we noticed, what you mentioned, we've seen this positive effect. We have the growing participation of the buy now, pay later in our sales, and also to be able to recover the indexes of approval and granting that we had in the past. So for the effects of the buy now, pay later, that's pretty much it. When you talk about the co-branded card, then we really have had a performance that is very significant in our presentation. We've had highlighted the growth of these participation from co-branded ever since 2020. So we grew this in our sales regardless, well, without cannibalizing the portfolio and the buy now, pay later. So we have this very safe strategy where both modalities of payments grow. And of course, each of them have their own characteristics. So the co-branded card, we know that up until a certain level has no interest, but these are different target audiences. But about the co-branded card, we've been able to perform in line with our targets, and we believe in the growth constantly, just as the buy now pay later in our sales. So when it comes to default, I'm going to talk about the fourth quarter and also what we've seen in the first quarter. We have two effects. So one is because of that small part because of this setback. We had this reduction in the portfolio. So um, I also talked about the revision of the policy we had mentioned. We were also noticing a worsening in the scenario, and we have this second effect where you have this positive effect as well because it's a consequence of payments from customers that were already in a portfolio above 90 days, and they had payments that we call partial payments, right? So what happens is you have maybe like 5 installments that are late, and they don't negotiate this, but they have the possibility of paying in 1 or 2 installments. So this provides two effects. First, the over 90 portfolio has more deterioration because the customers kind of stopped in this range of delays above 90 days. But this is an extremely positive effect because besides improving our indexes of recovery, it also contributes to our losses indicators. So our loss indicators, as you notice, they've dropped because of this effect with the recovery in our portfolios, and also because of the effect where you kind of hold out to the rollout without, if you didn't have these payments, these payments would pay the rollout to the portfolio above 180 days. So when it comes to the beginning of the year, January and February, I also mentioned that we had performed some careful openings for our credit policy. Um, because we've had some excellent indicators. So this allows us to have provisioning indicators and the overall, so it's smaller in the next quarters. Uh, and also we can sell more in the buy now pay later modality. Well, very clear. Thank you. Well, our next question is from Nicholas from JP Morgan. Nicholas, please. Well, thank you, Gabriel, and good afternoon, everyone. Thank you for taking my question. I had two actually. First, I wanted to know about your guys' plan to try to understand if these two EBITDA points we should see spread out throughout the year, or if it's just more of a case where we're looking at this from the second quarter up ahead. And so the second question is about those suppliers. I wanted to know if you've seen some better procurement terms in the last month and what your relationship is on that side. Thank you. Well, good afternoon. Thank you for the question. From the efficiency perspective, I think that it's going to happen throughout the year. So we'll have this capturing process throughout the year and maybe a little lower now in the first quarter, but a little more accelerated in the second quarter. There's a lot of things we're doing that won't be full in the quarter. So throughout the year, we should see this evolution in the productivity at VIA. So when it comes to suppliers, I'd say that it's a pretty good ratio. VIA is super has super significant in the segments where it operates at 1P. So the ratio is really good. And considering the events that took place, we've seen suppliers looking at us um, as a strategic channel to offset these volumes. And so we've been moving along to help this happen, but without major bets on uh, an over volume of purchases and stocking. We'll be accelerating this level of purchases with the industries, but things are really under control regardless. Okay, very clear. Thank you. Thank you, Nicholas. The next question is from Iago from Genial. Well, good afternoon, guys, and thank you for taking my question. Some of them are already addressed, but I wanted to address this point from Nicholas. You guys did excellent work so far. Reduced the stock a lot without harming the revenue and the margins. So, what can we expect for 2023? Something similar to 2022? Is there better improvements? Could you give us some more granularity? That would be great. Well, thank you, Iago, for that question. So we reduced 1.6 billion and 25 days in the stock. So we are about 95 days at the moment. So I'd say that the levels of 2023 should be close to 95 days. Maybe, as I mentioned, we have the opportunity to work on something a little bit beyond this, but that seems to be really, really surgical. And there's some technological aspects that are taking place in logistics throughout this year that could open up other opportunities for us. But I'd say that it's close to something near this cycle that we're looking at, like 90 to 95 days coverage. And then the stock will vary according to the seasonality. But that should, when it comes to the UFC, it should be around that. Okay, thank you. Thank you, Iago. Our next question is from Eric from Santander. Hey, good afternoon, guys. Thanks for taking our question. I think on our side, we have a point here about the take rate. So we've noticed some news on the overall market when you look at profitability. And so just to understand, quarter over quarter, you had a bit of a drop in the take rate. If it was, I wanted to know if it's more like seasonality or occasional. And also, when you search for profitability, which seems to be a very frequent topic for all of the players, I want to understand if besides the fulfillment, which other, well, besides fulfillment and credit, which other levers you guys are looking at for a possible increase in take rates? And also, considering this moment where everyone's kind of increasing their rates a bit more, do you see a possible opportunity to capture a bigger amount of sellers or something in this sense with maybe maintenance of some rates versus the increase you've noticed in a more generalized way? Well, thank you, Eric, for that question. But what we've seen in the fourth quarter is pretty much the seasonality of the fourth quarter, and we've been able to. We actually were the first ones to increase the take rates in the market. Thankfully, most of the other players also followed along due to this need that everyone has at this moment to search for greater profitability. So the fulfillment is something that's really important for us to keep on leveraging the profitability with the sellers and the buy now pay later in the marketplace is also a big option. And so we also have various different things going on throughout last year, and we're forcing the sale of the sales with interest on credit cards. And this is something that's been very successful at the stores and so online as well, which should be matured by the online players in the search for profitability. So maybe this is a path we should follow as well. And we also have the ads program that should gain more relevance throughout this year. So we added this, and we have some improvements still to work on. We'll have some news coming along as well, but this will take place throughout the year. So we have different initiatives coming from different areas, but I think the biggest initiatives are really at the fulfillment level, where you have profitability gains and productivity gains. So the more we have the turnovers, the more productivity we have in the distribution centers and in our routes, and also through the buy now pay later funding items of the marketplace. Thank you. Super clear. Very good. Thank you, Eric and Roberto. Now I'll pass the floor to you because we have no other questions. Okay. So I just want to thank you all for your interest in our earnings call here. Nice to be with you and have a great afternoon.